Welcome to Qualified Business Income. And more importantly, it's about how to optimize that QBI. Now, I hear from accountants all the time that it's difficult to understand how to discuss things like this with their clients to get them excited about the possibilities. And so for that reason, I'm going to explain this strategy just how I would explain it to my clients to give you some ideas. The bottom line is be honest, be energetic, and be excited about the tax savings, and they will too. So for qualified business income, remember that this is a temporary provision and it's set to expire at the end of 2025. So we don't have much longer to use it. It was passed as part of the Tax Cuts and Jobs Act. And basically it represents a 20% deduction of the net business income of the business. So it's for pass-through entities, and they're able to take a deduction straight off of that income. So for partnerships, LLCs, sole proprietorships, and S corporations, the deduction, of course, is equal to 20% of qualified business income. Now, I'm going to get to the optimizing part in a moment, but first I want to briefly review how we calculate QBI. Now, there's a limitation for what are considered high income earners on the QBI deduction. What's high income considered to be? Well, right now for individuals, that's $182,100, and for joint filers, that's $364,200. And we'll talk about what to do next. Now, it's important to note that this is called the personal services limitation. And that's because for any business that's labeled a personal services company, there are restrictions on how much you can deduct. In fact, in some situations, you can deduct zero. Here's how this works. We look at the thresholds, as I mentioned, for what's considered to be a high income earner. And up to these threshold amounts, even if your business is considered to be a personal service company, your deduction is simply 20% of your qualified business income. Now, once your income reaches these amounts, and we're talking about taxable income here, it's not until your income exceeds $50,000 over this threshold for single filers or $100,000 over this threshold for married folks that you're completely phased out of this deduction altogether. So what kind of business you are is really key. And when we talk about the planning here in a moment, that's going to be a really important point. What's a specified service, trade, or business? Well, essentially that's defined for us in the law. And it's any trade or business within certain fields. Fields like law, health, consulting, even finances is on the list. And in addition to these that are specifically listed, there is this catch-all definition that says anytime the primary asset of a business comes from the skill or reputation of the employees or owners of that business, it's considered to be personal service. For this particular definition of service businesses, engineering and architecture services are excluded from counting as a specified service, trade, or business. So for all of your engineering and architectural customers, this isn't going to apply in terms of this limitation. Now, these limitations also apply to non-specified service, trade, or businesses. And so here on this chart, what I've done is I've broken up the thresholds. As you can see on the far left, I've got our beginning point, 182.1 for singles, 364.2 for joint. And then on the other end of the spectrum here on the right side of your screen, you'll see 50,000 over that threshold for singles and 100,000 over that threshold for joint filers. And then of course we have what's in between. Here's how the rule works. It's pretty simple. If your net taxable income is below what's listed on the left side of the chart, you simply take 20% of your qualified business income. That's your deduction, end of story. On the opposite end, if your income is above the high end of the threshold here on the right side of your screen, now we have to determine what kind of business it is. And unfortunately, if it's a specified service, trade, or business and taxable income are over these threshold amounts, unfortunately, the QBI deduction will be reduced to 0. Now, for those businesses that are non-specified service, trade, or business, with taxable income levels over these thresholds here on the right side of your screen, now we have some limitations that we need to tackle. The first possibility on the limitation is what we would call a comparison. We're looking at 50% of gross wages for the company, and we compare that number to 20% multiplied by our qualified business income. Whichever is less becomes the deduction amount. So in this option, wages become a limiting factor in how much you can deduct for your 199A deduction. Now we have a choice here, and a lot of people forget about the other option, but there is another option, and that is to compare your 20% of qualified business income number with 25% of wages plus 2.5% of your qualified assets. This is really good for businesses that have a lot in their fixed assets. So check out the balance sheet. 2.5% gets multiplied against the total for qualified assets. You add 25% of the gross wages for the company, and then you simply make that comparison, and it's the lesser of the two. Now, it can be complicated, so I've created a flowchart to help you analyze how to apply this deduction. It starts by asking what kind of business you're dealing with. Is it a specified service, trade, or business? And you can see the path to take here. Let's say it isn't. Now we're going to examine taxable income and compare it to those threshold amounts. Is taxable income over the threshold amount? And you can take either path depending on what your answer is. Let's say your taxable income in this situation is under the threshold amount. Again, it's really simple. QBI times 20%. Now, let's follow the path when it is a specified service, trade, or business. Now, this is where a lot of accountants get confused. When you're dealing with a specified service, trade, or business, or SSTB, it's still possible to qualify for your 20% of QBI deduction, as long as your taxable income is under the bottom of the threshold amounts. Again, you simply take 20% multiplied by your QBI, and even for an SSTB, it's possible to get that deduction. So that can be an easy fix when you're reviewing a tax return for a new prospective client, for example. Check to make sure that QBI has been calculated optimally. And the next question you want to ask yourself is it possible to increase that deduction? We'll get there in a moment. We've got our limiting factors here. The primary one you want to concern yourself with is wages, and that's because wages is included in both of the factors. In one instance, we're comparing to 50% of the wage total for the business, and in the other, we're comparing to 25% of wages plus 2.5% of the qualified property total. You simply compare, use the bigger one, because that's going to represent your limitation. Compare that to your QBI times 20%, and now you know what your deduction amount is going to be. Now there's all kinds of official definitions, so you can pause the screen and take a look here. What's important for you to understand are the definitions of specified service, trade, or business, and you also want to understand what counts as qualified business income. This is the net amounts of income or gain minus the deductions. Essentially, in most cases, it's going to be that net pass-through amount that shows up on a K-1, for example, or the net profit from a sole proprietorship appearing on Schedule C. Now, it's possible to have negative QBI, and there's special rules that apply in terms of carrying that forward and reducing your current year's qualified business income. Now, there's one more limitation that I want to make sure you're aware of, and that is your taxable income amount. So we talked about the thresholds here and comparing it to the wage limitation or the wage and property limitation. But there's also a limitation on taxable income. Your 20% of QBI cannot exceed 80% of your taxable income. So that can also put a limitation on how much you're able to deduct in that situation. Now, how do we know what qualified assets are? Is we look at the total of any assets that were placed in service within the last 10 years of the date you're examining, and you simply take the initial basis. That means before depreciation is taken, then you multiply that by 2.5%, add it to your 25% of wages, and now you've got your limitation amount. Now let's talk about how to optimize. In other words, from a compliance perspective, we're constantly asking ourselves as accountants, do they or don't they qualify for this? Oh, 20% of wages is X, they qualify for X. But in planning, it's different. The question we're asking ourselves in planning is, how do we get more? So it's not just enough to say, did they take QBI? It's, here's what QBI they took, and is there an opportunity to increase that deduction amount? And here are the ways you can do it. First of all, you want to validate that the business is really a specified trade or business. Now, I see lots of mistakes made here by accountants. Either they believe that since it is a specified service, trade, or business, they get no deduction at all, which just isn't true. We simply have to look at the net income amount, compare it to our thresholds. As long as their taxable income is below the bottom of the threshold, it doesn't matter that they're specified service, trade, or business. They still get the deduction. Now, oftentimes, businesses can be misclassified. So I see this mistake made a lot. For example, this comes up often with consultants. A lot of freelancers will indicate that their occupation is consultant. And as you know, consultants are considered a specified service, trade, or business. Well, the IRS has actually clarified for us and issued regulations in an effort to more specifically identify the types of businesses that are really specified service, trade, or business. And consulting was an interesting definition. And in fact, most people that we label as consultants or who might label themselves as consultants do so in an inappropriate way. The official definition of a consultant is a person that gives advice and counsel to assist the client achieve a goal or other objective or solve problems. So you want to definitely ask, are they a true consultant when we apply this definition? And chances are, if they don't actually provide advice and counsel to solve a specific problem or accomplish a specific goal, then they're mislabeled, and oftentimes you can reclassify them and now benefit from that QBI deduction. So the first thing I want to point out with on the left side of the screen here is validate. Validate that what they're saying about the business is actually true, particularly if they're being limited because they're considered a specified service, trade, or business. Now, you want to make sure that you're very thorough here and validate the SIC code to be consistent with what you're claiming about that business. And finally, we'll talk about carve-outs in a few moments, so that if you in fact do have a specified service, trade, or business, it might be possible, for example, to carve out some of that income so that they can at least qualify for something. So the question we want to ask is, can QBI be increased? What we want to understand is how and why is the current qualified business income deduction being limited? So I like to do a little expectation test, and when I first look at a tax return and identify what the deduction is, I compare it to, is that what I expected it to be? And if not, I want to find out why. So you're going to go to your 8995 form and you're going to identify the limiting factor. Is it because wages kicked in? Is it because it's an SSTB? Is it because property amount is too low? So it starts by identifying what's limiting that deduction in the first place before we can then develop a plan to navigate around that limiting factor. So if you're limited by the thresholds, the first thing you want to examine is, can we lower taxable income such that we are not over those thresholds? If my taxable income is over the top of the threshold, I don't qualify. But if there are ways we can reduce taxable income through all of the tax planning strategies we know how to do, then it can help someone qualify for more and or something for that QBI deduction. We can do this by taking advantage of deferral strategies like retirement accounts or income shifting, where we're moving income taxable on one tax return and moving it to another year or to another person or place. You can also consider other types of deductions that will help lower taxable income below that threshold amount. Things like charitable deductions, for example. If the QBI deduction is being limited by wage and property factors, ask yourself if those factors can be increased in any way. And we're going to look at an example in a moment here that illustrates this perfectly. Things like a compensation analysis, for example, to make sure that the officer of the company is being paid a reasonable wage. Sometimes that wage can be too high, sometimes that wage can be too low, and it could be actually limiting how much QBI is deductible. We're going to talk about guaranteed payments through a partnership, but this is another big area. Unfortunately, guaranteed payments in a partnership reduces QBI, which in turn is going to reduce your deduction, and yet guaranteed payments are not considered qualified wages. So when we're applying that wage factor, it doesn't do us any good. So my advice here is to review the partnership agreement. Does it actually indicate that there should be a certain amount of guaranteed payments, or is it possible to change the operating agreement? Well, the only way you're going to know that is to actually talk to the partners about it, but that's a conversation you can have as a possibility of reducing tax. The last thing you can do has to do with the property factor and looking at the de minimis expensing for depreciating assets as an example. By raising the threshold of office equipment, for example, from $2,500 to $5,000 might help us move that property factor from the balance sheet to the profit and loss statement and vice versa. If we reduce our de minimis level, we can shift more property to the tax return on the balance sheet without reducing QBI. Now let's run through some examples so I can illustrate what I'm sharing. The first example, we assume that the taxpayer's married filing joint and has a Schedule C business. They're a sole proprietor and they have net income of $300,000 from a non-personal service company with $560,000 of overall taxable income. So remember our steps in the process. The first starting point says, is it a specified service, trade, or business? In this case, we're going to answer yes. Now we look at taxable income. Is taxable income over the threshold? And actually, in this case, it is. When we look at the married filing joint income amounts, and we've got $560,000, it is in fact over the threshold for joint filers. So we continue down in the flow chart. Is taxable income over the full phase-in? And the answer to that is yes in this case. So what's interesting is that if it's a specified service trade or business in our example, they would qualify for no deduction at all. Now, let's go back to our example because it actually says that they're a non-specified service trade or business. So we start out at our first starting point here. Is it a specified service trade or business? And we answer no. Now we look at taxable income again. Is it over the threshold? We know that it is, so we'll follow yes. Is it over the full phase-in? And the answer is yes. So this tells us now we just have to calculate our deduction. 20% of QBI, and then we're going to compare it to our limiting wage factor. Now here's where things get interesting. The unadjusted deduction is actually equal to 0 in this case, and here's why. We have a couple with income that's over the high end of the threshold. However, in a sole proprietorship, if you're the only worker in that business and you don't have any additional employees, your payroll amount is 0. Now, when we go to calculate our threshold, 50% of 0 is 0, and of course, our deduction is equal to the lesser of the two numbers. So in this case, our wages are 0, which impacts our ability to deduct QBI, makes our QBI 0 as well. So here's where the opportunity for planning comes in. This company may in fact be better off as an S corporation. If we assume the business is an S corporation with $50,000 as a reasonable compensation for the officer, then our adjusted deduction ends up being $25,000. And the way we calculate it again is to take 50% of our $50,000 in wages total, that's $25,000, and we compare that number to 20% of $300,000. Now the max somebody could deduct in this case would be $60,000, but with the limitation here of 25, they're limited to just 25. But hey, they were at 0 before, so $25,000 is quite a bit of tax savings. Now let's see what happens when we increase our wage to $100,000. In this case, we're going to adjust our wage. Now keep in mind that our QBI is going to be affected. We no longer have $300,000 in QBI. In fact, we've got $200,000 multiplied by 20% gives us $40,000 as a maximum potential. Now 50% of the total wages of $100,000 gives us $50,000, which is more than we really need because the max we can deduct is 20% of QBI. It's a lesser of two numbers. So in this instance, the deduction equals $40,000. Now, most of the time you can do this math just simply looking at the wage factor, but keep in mind that the 25% of wage plus the 2.5% of your fixed assets total could also be an option for you if they've got a lot of assets. So to sum up, our tax planning in this situation identified that a sole proprietorship is probably not ideal. Because of 0 wages paid out through the sole proprietorship, it was impacting the taxpayer's return so that they got 0% as a deduction for QBI. By making a few simple changes, such as changing to an S corporation and adding some officers' compensation, we can adjust that QBI deduction from $25,000 to $40,000, all depending on what the reasonable wage is. Now that's a big tax savings. If we move on to the second example here, again, let's assume that the taxpayer we're working with is married filing joint, and they have an S corporation that has net income of $100,000. Again, we're dealing with a non-personal service company. They've got $200,000 in wages, and they have $560,000 overall taxable income. So you know the drill. Here's what we're doing. We start, is it an SSTB? The answer is no. So we go to the net income test. Does their taxable net income rise over the bottom or top of the threshold? And the answer is yes. We know that from the previous example. So again, we're running into this wage limiting factor, and here's where we apply it. First, we're going to calculate 20% of our existing QBI. 20% of $100,000 is, of course, $20,000. And we're going to compare that to 50% of our $200,000 in wages. So, of course, that number is $50,000. So our unadjusted deduction is going to be equal to $20,000 because that's the lesser of the two numbers. Now, we walk into the situation, we're looking to do some tax planning. We've identified that the entity choice seems okay, but the next thing we want to look at is, are the wages reasonable for the work that the officer's actually doing? Because here's what happens. As we decrease officers' compensation, QBI goes up because we're subtracting less to get at our net income number. So if we reduce wages to $120, now, legally speaking, the wage needs to be reasonable. So make sure that you're working within that framework. We decrease our wages to $120,000. That impacts our $100,000 in QBI. In fact, QBI is going to go up by $80,000. That gives us our deduction of $56,000. So we have the same set of circumstances. We have done some planning to identify some ideal target amounts. And in this case, we've taken a deduction from $20,000 all the way up to $56,000. Again, that's real value there. Now let's talk about carve-outs. In the instance where you have a specified service trade or business, they might not all be earnings from a specified service trade or business. Lots of businesses have multiple sources of revenue streams coming in, and some of those income streams might be SSTB, while others are not. It's possible to do what we call a carve-out, so that we have some QBI to deduct versus all of the SSTB, which might be limited. So we use income shifting to accomplish this goal. Now you can use income shifting with lots of different strategies. For example, you can shift income to an entity. I'll show you that next. You can shift income to one or more owners. You can even shift income to customers, depending on how you do your pricing. So originally, we've got one business that's housing all of these different forms of revenue. And what we do with the carve-out is we identify which revenue streams come from non-SSTB activities. And what we do is we simply create a second business in order to receive those non-SSTB revenues. What we've done effectively is left the SSTB where it is. There's no real way to get around it. If you're above the threshold on the income limitation and you're an SSTB, you just simply don't qualify. In that case, you might want to check out a C corporation. But by splitting this out and carving out the non-SSTB income, we change where the income is being received. Instead of being received by the original entity, we have it received by the new entity. And the owner, of course, is the same in both situations. What we're doing is we're physically picking up that cash and moving it to another entity. We're shifting that income. Now, it's best in this situation when you have your customers used to paying one entity, you're going to need to make some adjustments. And I recommend having the customers pay the new entity directly for the non-SSTB income. there are some important IRS regulations that you need to be aware of. For example, let's say you had the customers still paying the original SSTB, and then in turn we have the SSTB pay our new entity. The regulations specifically state that this entity would also be considered to be an SSTB. So to avoid that classification, we must have the customers paying that new entity directly. So what does that look like for your clients? It might look like two separate point of sale systems, for example. I'll give you an idea of who this is ideal for. People in the medical field. First, it's an SSTB, but if you have physicians as clients, you may have some that have retail sales of products, for example, or they may receive income from clinical studies or trials. That's not considered to be specified service, trade, or business. Again, we simply identify that stream. We use a carve-out to create a new entity that is considered non-specified service, trade, or business. And now we apply our 20% QBI deduction right here. Of course, the original business we can't really do anything about. If it's SSTB, it's SSTB. But in this situation, we're going from zero deduction to something, and that's planning. So to summarize, you want to identify first what you expect QBI to be. You double check to identify what it currently is. And if your expectation is that it could have been higher, now you want to move into your planning strategies to identify what's the limiting factor, and is there any way legally to help improve that limiting factor so that more can be deducted. I hope this helps give you some ideas on how to share this with your clients and get them eager about working with you to save on tax. If you'd like to get more ideas on advanced tax reduction or how to incorporate tax advisory services, specifically tax planning, into your business, visit the website listed on the next slide.